The global silver market is drawing heightened attention today, following a sharp price movement that has unfolded over a short period of time. Midday trading on the U.S. East Coast showed silver reaching a bid price of $94.53 per ounce, marking a 41% increase over the past month. The move represents one of the most rapid short-term price advances seen in recent years, and has prompted renewed discussion across financial markets, commodity desks, and trading floors worldwide. According to a private commodities analyst with more than 12 years of experience tracking the physical silver market, the current conditions differ notably from previous silver rallies. The analyst reports that the price movement occurred within hours of routine market monitoring and reached levels that had not been observed in prior cycles during their career. While broader financial media outlets have characterized the rally as speculative and have drawn comparisons to earlier silver market reversals, the analyst states that those comparisons fail to reflect current market dynamics as observed in physical supply channels. At the center of the discussion is a growing divergence between the price of physical silver and the performance of silver mining equities. While the price of silver has risen by approximately 41% over the past month, major silver mining stocks, tracked by the SIL Exchange Traded Fund, have increased by only 16% during the same period. This 25% gap has become a focal point in the debate, with some market commentators suggesting it reflects skepticism about the sustainability of the silver price increase. Others argue it points to a structural delay in equity market pricing. The analyst referenced the total valuation of the global silver mining sector, estimating it at approximately $300 billion. That valuation, according to the analyst, remains smaller than several individual multinational corporations operating outside the commodities sector. The comparison is being used to illustrate the relative size of the silver mining industry within global capital markets and the potential implications of increased investment interest in a limited market space. Beyond price movements, attention is also being drawn to developments in physical silver availability. The analyst reports that conditions at physical silver vaults and dealer networks, particularly in Asia, are showing signs of strain. In Shanghai, silver traded on the physical market is reportedly priced at levels exceeding $103 per ounce, representing a premium of approximately $9 over prices observed in Western paper markets. Such a price differential is being described as significant within the physical commodities trade, where smaller spreads are more typical under normal conditions. The analyst explains that this price gap has created arbitrage opportunities, incentivizing the movement of physical silver from Western markets to Asian buyers. As a result, inventories held in Western vaults are reportedly declining as metal is transferred to capture the price differential. While these developments are not always reflected immediately in futures pricing or exchange-traded products, they are considered relevant indicators within physical commodity markets. Retail market conditions have also entered the discussion. According to the analyst, one of the world's largest online precious metals dealers has introduced a minimum purchase requirement of $500 for silver orders. Additionally, the dealer has reportedly acknowledged a reduction in output of approximately 50% due to supply chain disruptions. These measures are being presented as evidence of tightening supply in the retail segment, rather than routine operational adjustments. The analyst emphasizes that the current situation is being shaped not solely by price charts, but by physical market constraints. In this context, the availability of physical silver, rather than its quoted price alone, is being highlighted as a critical factor. The analyst describes the metal as increasingly difficult to source in meaningful quantities through traditional channels, particularly for large-scale buyers. The disconnect between silver prices and mining equities is being framed as a key issue moving forward. The analyst notes that mining companies operate with relatively fixed, all-in sustaining costs, meaning that increases in the price of silver have a direct and amplified impact on profitability. However, equity valuations, according to the analyst, have yet to reflect this shift due to the timing of quarterly earnings reports and conservative pricing assumptions used in analyst models. While financial commentators continue to debate whether the recent price action represents a temporary surge or a longer-term adjustment, the analyst argues that current market signals are being misunderstood when viewed through historical comparisons alone. Instead, attention is being directed toward physical market data, supply constraints, and valuation metrics that may not yet be fully reflected in equity prices. As the market continues to absorb these developments, the focus now turns to how these dynamics are unfolding beneath the surface of headline price movements. In the next part of this report, we will examine the underlying mechanisms cited by the analyst, including cost structures, profit calculations, and the emerging role of physical market premiums as the silver market enters what is being described as a critical phase. The widening gap between the price of silver and the valuation of silver mining companies is being attributed by the analyst to a fundamental mechanism within the mining industry known as operating leverage. According to the explanation provided, mining companies operate with largely fixed all-in sustaining costs, commonly referred to as AISC. These costs include fuel, labor, equipment operation, and ongoing maintenance, and they do not fluctuate significantly in response to short-term changes in the market price of silver. As a result, when the price of silver rises well above these fixed costs, each additional dollar of price increase translates directly into expanded profit margins. The analyst explains that this dynamic is often overlooked or underestimated by market participants. When silver is priced near lower historical averages, profitability is limited. However, when prices rise substantially above production costs, earnings can increase at a much faster rate than the underlying commodity price. Using current conditions as an example, the analyst states that if average sustaining costs are approximately $20 per ounce, silver priced in the mid-$90 range results in a significantly higher profit per ounce than pricing assumptions currently reflected in many equity valuations. According to the analyst, market models used by major financial institutions are still operating on assumptions that place silver prices closer to $55 or $60 per ounce. Under those assumptions, profit margins are materially lower than what current market prices imply. The analyst states that the discrepancy exists because quarterly earnings reports have not yet captured the full impact of recent price increases, and because analysts have not adjusted projections to reflect current spot pricing. This delay, the analyst argues, has contributed to the lag between the metal's price and mining stock performance. The analyst further highlights that this gap becomes more pronounced when current spot prices are compared directly with existing valuation frameworks. At silver prices near $93 per ounce, profit per ounce more than doubles compared with profit levels assumed at $55. Despite this, equity prices have not adjusted accordingly, creating what the analyst describes as a mismatch between operational reality and market perception. Beyond operating leverage, the analyst draws attention to developments in global physical silver markets, particularly in Asia. On the Shanghai Physical Exchange, silver is reportedly trading at a price exceeding $103 per ounce, creating a premium of approximately $9 compared with prices in Western paper markets. The analyst describes this premium as unusually large and states that it is functioning as a powerful incentive for arbitrage activity. According to the explanation provided, traders are able to purchase silver at lower prices in Western markets and sell it at higher prices in Shanghai, capturing the spread after accounting for logistics and insurance. The analyst emphasizes that this process is not theoretical and is actively occurring, resulting in the movement of physical silver from Western vaults to meet demand in Asia. As this activity continues, inventories held in Western storage facilities are reportedly declining. The analyst notes that in physical commodity markets, sustained premiums of this size are not considered minor pricing discrepancies. Instead, they are viewed as signals of underlying supply and demand imbalances. In this case, the analyst states that demand in the Eastern physical market is exceeding available supply, placing pressure on global inventories and contributing to tighter conditions. Retail market indicators are also cited as supporting evidence of constrained supply. The analyst reports that a major online precious metals dealer has implemented a minimum order requirement of $500 for silver purchases. Additionally, the dealer has reportedly acknowledged that output will be reduced by approximately 50% due to supply chain disruptions. According to the analyst, such measures are uncommon outside of periods of heightened stress within the physical market. The analyst states that these developments reflect operational adjustments rather than marketing decisions. Minimum purchase thresholds, the analyst explains, are typically introduced when inventory availability becomes limited and fulfillment capacity is under pressure. In the analyst's view, these changes signal that retail demand is colliding with reduced supply at the distribution level. The implications of these conditions extend beyond individual investors. The analyst points out that large institutional participants, such as pension funds, are unable to source significant quantities of physical silver through traditional retail or vault channels when supply is constrained. As a result, the analyst argues that mining equities remain one of the few liquid avenues available for institutions seeking exposure to silver under such conditions. While acknowledging that some market participants anticipate a price correction or broader market disruption, the analyst references structural supply data to support the current narrative. According to the information cited, the silver market recorded a deficit of approximately 150 million ounces in 2025, marking the fifth consecutive year in which demand exceeded supply. The analyst emphasizes that mining supply cannot be increased quickly in response to higher prices due to long development timelines. Exploration, permitting, financing, and construction cycles, the analyst explains, typically span 10 to 15 years before new production comes online. As a result, even sustained higher prices do not immediately translate into increased supply. This structural constraint, according to the analyst, differentiates the current environment from past silver rallies that were driven primarily by investment demand rather than physical shortages. As these factors converge, attention is increasingly focused on the gap between current market conditions and prevailing valuation assumptions. In the next part of this report, we will continue examining how these dynamics are interacting with equity markets, earnings expectations, and institutional participation, as the silver sector moves deeper into what the analyst describes as a critical adjustment period. As the analyst continues outlining the current conditions in the silver market, further emphasis is placed on the numerical gap between prevailing assumptions and real-time pricing. The analyst revisits the comparison between two scenarios used to illustrate this divergence. In the first scenario, which reflects what the analyst describes as the prevailing consensus view, silver is priced at approximately $55 per ounce, with average all-in sustaining costs estimated at $20. Under those conditions, profit per ounce stands at roughly $35. In the second scenario, which reflects the current market environment, silver is priced near $93 per ounce while sustaining costs remain unchanged. This produces a profit per ounce of approximately $73. According to the analyst, this represents a 69% increase in the price of silver, generating an increase of more than 108% in profit per ounce. Despite this, mining equities have not adjusted to reflect this change, in part because earnings reports reflecting these margins have not yet been released. The analyst states that equity markets remain anchored to outdated assumptions while actual revenues are being generated at significantly higher levels. The analyst also addresses potential counterarguments raised by skeptics who expect a broader market downturn or deflationary event to pressure all asset classes, including mining stocks. While acknowledging that forced liquidation events have occurred in past market crises, the analyst argues that such scenarios do not eliminate underlying supply deficits in the physical silver market. According to the data cited, the silver market has experienced consecutive annual deficits, and the absence of sufficient exploration spending over many years cannot be resolved through short-term price corrections. The analyst reiterates that silver production cannot be scaled rapidly in response to demand. Even under conditions of elevated pricing, new supply would not materially enter the market for many years, due to the time required for exploration, permitting, and development. As a result, the analyst suggests that expectations of a sustained return to significantly lower price levels may not align with current supply realities. Attention then returns to the divergence between physical silver pricing and mining equity performance. The analyst notes that during the recent month, physical silver prices increased by approximately 41%, while the CL Exchange Traded Fund, which tracks major silver miners, rose only 16%. According to the analyst, this disparity is unusual when compared with historical patterns, where mining equities typically amplify moves in the underlying commodity due to operating leverage. The analyst outlines two possible interpretations of this gap. One is that markets are signaling a lack of confidence in the durability of current silver prices and are pricing in a reversal. The alternative interpretation, according to the analyst, is that equity markets have not yet recalibrated to reflect the impact of current pricing on profitability. Given the supply constraints, physical premiums, and retail shortages previously described, the analyst states that the latter interpretation is more consistent with observable data. Additional focus is placed on institutional behavior and market structure. The analyst notes that the total market capitalization of the silver mining sector remains relatively small in comparison with global equity markets. This limited size, combined with low average trading volumes, means that even modest allocations from large institutional investors could have a disproportionate impact on prices. The analyst illustrates this by referencing hypothetical allocation decisions, noting that a relatively small percentage shift from a single large fund could represent a significant share of total sector capitalization. According to the analyst, this dynamic creates what is described as a liquidity constraint. When liquidity is limited, large buyers cannot enter positions without influencing prices. The analyst references similar conditions observed in other commodity-related sectors, where increased institutional interest resulted in rapid price adjustments due to insufficient available supply of tradable shares. The analyst also highlights changes in trading activity as a key indicator to monitor. Volume levels in sector-specific exchange-traded funds are cited as a potential signal of institutional participation. Under normal conditions, daily trading volumes remain relatively modest. A sustained increase in volume, according to the analyst, would suggest that larger market participants are beginning to establish positions. The discussion then turns to upcoming corporate earnings reports. The analyst states that quarterly results are expected to reflect the full impact of higher silver prices on revenue and profitability. Since costs remain largely fixed, the analyst anticipates that reported margins will increase sharply compared with previous quarters. Once these results are made public, the analyst expects that valuation models will need to be revised to incorporate updated price assumptions. The analyst explains that institutional investors often rely on reported earnings, analyst revisions, and formal upgrades before committing capital. As a result, the period between price movements in the commodity and the release of earnings reports can create a temporary disconnect. According to the analyst, this period represents the current phase of the market, where underlying fundamentals are changing faster than consensus expectations. The analyst also revisits historical comparisons, particularly the silver rally of 2011. According to the explanation provided, that episode was driven primarily by investment flows rather than structural supply deficits. When demand subsided, prices declined sharply. The analyst argues that the present situation differs because it is characterized by sustained supply shortfalls, ongoing industrial demand, and pricing disparities across physical markets. The analyst emphasizes that in the previous cycle, mining equities advanced ahead of the metal, leaving them vulnerable when prices fell. In contrast, current conditions show mining equities lagging behind the metal, which the analyst states may provide a different risk profile. This inversion, according to the analyst, is a key distinction between the current environment and prior market cycles. As these elements continue to interact, the analyst maintains that attention should remain on physical market indicators, inventory levels, and forthcoming earnings data. In the final part of this report, we will summarize the key points raised and outline how these developments are being framed within the broader market narrative, as the silver sector approaches an important inflection point. As the discussion moves toward a conclusion, the analyst brings together the various elements shaping the current silver market environment, emphasizing that the situation cannot be understood through price movements alone. According to the analyst, the defining features of the present moment include sustained supply deficits, elevated physical market premiums, constrained retail availability, and a persistent valuation gap between physical silver and the companies that produce it. These factors, taken together, are described as forming a market structure that differs materially from prior silver cycles. The analyst reiterates that the silver market recorded a deficit of approximately 150 million ounces in 2025, marking the fifth consecutive year in which demand exceeded supply. This data point is presented as a structural condition rather than a temporary imbalance. The analyst stresses that such deficits cannot be resolved quickly, as silver production is dependent on long development timelines and years of prior investment in exploration and infrastructure. As a result, higher prices alone do not immediately lead to increased supply. Returning to physical market conditions, the analyst again highlights the price premium observed in Shanghai, where silver has been trading at levels more than $9 above Western paper market prices. This premium is described as a persistent signal of demand pressure in the Eastern physical market. According to the analyst, arbitrage activity driven by this price difference continues to draw metal out of Western vaults, reducing available inventories and tightening overall market conditions. Retail market developments are also revisited as part of the broader summary. The analyst notes that the introduction of a $500 minimum purchase requirement by a major online precious metals dealer, along with a reported 50% reduction in output due to supply chain disruptions, reflects operational stress within the physical distribution network. These measures are characterized as responses to limited availability rather than discretionary business decisions. Against this backdrop, the analyst underscores the significance of the ongoing disconnect between silver prices and mining equities. While physical silver prices have risen by approximately 41% over the past month, mining stocks tracked by the Sahel Exchange Traded Fund have increased by only 16%. This 25% gap is described as unusually wide, given the operating leverage inherent in mining businesses, where profits expand rapidly when commodity prices rise above fixed production costs. The analyst explains that current equity valuations remain anchored to outdated pricing assumptions, largely because quarterly earnings reports reflecting higher silver prices have not yet been released. As these reports become available, the analyst expects that the impact of higher margins will be visible in reported financial results. This, in turn, may prompt revisions to analyst models and valuation frameworks that currently assume significantly lower silver prices. Institutional behavior is again addressed as a critical factor. The analyst points out that the silver mining sector's relatively small market capitalization and limited liquidity mean that even modest institutional allocations could materially affect prices. In such an environment, the ability of large investors to enter positions without influencing market prices is constrained. This dynamic, according to the analyst, has implications for both timing and price discovery once broader participation begins. The analyst also references trading volume as an indicator of shifting market participation. Under normal conditions, sector-specific, exchange-traded funds see relatively modest daily volumes. A sustained increase in volume would, in the analyst's view, suggest that larger market participants are beginning to establish positions, potentially accelerating price adjustments across the sector. Historical comparisons are addressed one final time, particularly concerns that the current rally could mirror the silver market reversal of 2011. The analyst reiterates that the earlier episode was driven primarily by investment demand without a comparable structural supply deficit. In contrast, the present environment is described as one in which physical shortages, industrial demand, and constrained supply form the foundation of current pricing dynamics. The analyst emphasizes that mining equities entered the current period undervalued relative to the metal rather than overextended. This distinction is presented as an important contextual difference when assessing risk. According to the analyst, the lag between metal prices and mining stock valuations reflects delayed recognition rather than excess speculation. As the report concludes, the analyst characterizes the current phase as a transitional period where underlying fundamentals are evolving faster than market consensus. The analyst stresses that attention should remain on physical inventory levels, regional pricing disparities, and forthcoming earnings data rather than short-term price fluctuations or media narratives. In closing, the analyst reiterates that the developments described are based on observable data from physical markets, corporate cost structures, and reported supply figures. No forecasts or guarantees are offered. Instead, the focus remains on the convergence of multiple market signals that, according to the analyst, are unfolding simultaneously. With physical silver availability tightening, price differentials persisting across regions, and mining company profitability changing in real time, the analyst concludes that the silver market is entering a period of adjustment that warrants close observation. As additional data emerges through earnings reports and market activity, participants across the financial system will continue to reassess how these conditions are reflected in pricing and valuations. That concludes this report. Thank you for watching, and we will continue to follow developments in the silver market as new information becomes available.